This episode is brought to you by Avalanche, the layer 1 that is blazingly fast, low cost, and eco-friendly. You'll hear more about Avalanche later in the show. All right, we got a big app. Look at this. I've been prepping. All right, we got 1 cup of coffee. We got a second coffee.
Jesus Christ.
We got ice. We got my sparkling water. So we are ready for a big episode here.
Let's go. We did not we did not coordinate. We're not supposed for everyone listening. We do not coordinate on what we're wearing, right? We still don't have Empire merch, although maybe we should at some point. But today we're wearing some pretty old grandpa sweaters, man. So
I got a haircut and I've got this sweater on. I feel like I'm looking like a little too dapper here. So.
Hey, man. Well, you know, it's a big week, a lot to cover. I'm actually excited now to go on video. I know last week I was MIA, but I'm glad to be back.
We are going to be chatting about a big chat on tokenomics today. If you guys missed last week's episode on the curve wars, I'd maybe go recommend you listen to that before this one. I think first we'll start off with a quick market update, if that sounds good with you. Then we'll spend a little bit of time on, actually probably a lot of time on Andre's projects. Andre being, we'll talk about who Andre is later, but Yearn and VE3 of 3. Then obviously you guys know we love to talk about the L1s. There's some interesting L1 stuff happening. Then NFTs. Then got to break down some of the Coinbase acquisition that happened, and of course Citadel and Paradigm coming together a little bit. Pretty interesting to see. Good ep ahead. Before we get into the ep, big permissionless shout out. If you are listening to this on Friday, you are lucky. You are lucky. January 14th, if you're listening to this the day it came out, go get your ticket. Tickets go up tomorrow. If you are listening on January 15th or later, you're not so lucky. I'm sorry. But yeah, today, $732. Tomorrow, $841. Remember, every 2 weeks, tickets go up 15%.
We should be pricing these in ETH or SOL terms or Bitcoin terms. You know, there is a mental frame. No. I mean,
it's true. It's true.
It's true. Like we are okay paying gas fees and so. I think your mental model when you're purchasing with crypto is way different, right? Like you know, paying like $10 for something it sometimes seems absurd, right? But when you think about like our consumer behavior and habits and purchasing behavior in crypto is vastly different, at least in my life. And I think I've talked to other people that feel the same way. So you should start pricing now. Tickets are in Bitcoin, ETH, and SOL terms. I think that would be better right. for selling out. I mean, we're going to sell out no matter what. I'm really excited to go. I'm actually planning my trip there now. And so, but yeah, we should price it in Bitcoin terms or crypto terms.
I think you're right. All right. So as Santi said, tickets right now are 0.22 ETH. Go get your ticket right now. But you're totally right? People want to spend like, if I saw $10,000 for an NFT, I'm like $10,000. But if it's like, oh, it's 3 ETH. All right, cool. Toss a couple casino chips there. Anyways, market update, Santi. Crypto market cap has dropped from nearly $3 trillion market cap in mid-November to as low as $1.85 trillion. The market's obviously recovered a bit, right? We're up to nearly like, I think it's like 2.1, 2.2 trillion, but still feels like there's a lot of uncertainty. And there's obviously a whole bunch of reasons for this, right? Some of the macro things, it's, you know, December's weak jobs report and the Fed's decision to kind of reduce the rate of asset purchases as well as increase interest rates. Obviously a big liquidation event that happened on January 5th, liquidations across exchanges, wiped out about $800 million off the market. I think there are 2 big numbers to look at here. One is the CPI print, and 2 is open interest. So on CPI, the quick story here is yesterday CPI came out, showed a 7 handle, right? 7% year over year inflation, highest in 40 years. Bitcoin jumped 3%, outperforming equities on the day. Good branding. This is just, my take is just, it's great branding for the store value use case. CPI up, Bitcoin up. What are your thoughts here?
Yeah, well, first of all, it's as you said, inflation is been front and center since Q4. The way I've been thinking about it, okay, is like, do you believe in this transitory inflation phase? There are 2 things that cause inflation. One is obviously a supply shock. In COVID, there's just been a bottleneck and a lot of congestion in supply chain. So what does that do, right? That naturally increases. If you think about the supply and demand curve, right? That has led to an increase in a lot of prices across the board. raw materials, you look at shipping containers, there's a lot of backlog because, things are slowing down. So everything's come grinding to a halt. Now, if you believe that Omicron is sort of like a much more milder version of the original variant, then do you see a path where that supply shock goes away later this year? And then you catch you sort of tame down inflation. So a lot of the commentary that I've been listening to is they believe that, look, inflation is going to come down, it sort of reach its peak, and things are going to subside. But there is still the other component of what causes inflation, which is a demand shock. And so that's obviously been what is more relevant for crypto, which is this idea of a store of value. Obviously with money printing comes, a natural rise in prices. And I think that is something that when I was listening to Powell just in his congressional kind of hearing, what was interesting was a lot of, I think the commentary coming out of that is, how are you really going to wane off of these unhealthy, I think he used the word unhealthy debt levels. I think he's sort of come to terms that, look, we all know, right? I mean, you look at the deficit that the government is running is not sustainable. The question is how unsustainable that is. And that has always been the case for a digital asset store value like Bitcoin. And so, yeah, I think it's pretty positive, as you said, that you see Bitcoin rally. I mean, to be fair, though, I think there tends to be a lot of pricing behavior in anticipation of these events. And as we tend to, if you look at open interest and you look at, how crypto markets behave coming into this meeting, there's a lot of anticipation. I think it's always sort of like, you could argue that the markets had had declined and had, come down quite a bit. And then it was just sort of a relief rally. But, who knows if we're back in bull market territory.
Yeah, totally. I mean, let's not get into this. There's this one post, because I'm not sure if you've read it, so we won't talk about it. But the original bull case for crypto, for Bitcoin, was that ever-growing government debt would lead to an inflationary devaluation of the dollar, right? But what's actually happened is that higher government debt has been correlated to actually lower inflation over the years. And there's this guy, Alfonso Picatello, who has a great explainer on why some of these deflationary forces like high debt and low birth rates and technological disruption has actually counterintuitively been bullish for Bitcoin. So we'll link that in the show notes. Santi, you mentioned open interest. I think this is the other metric to look at here. For those who don't look at open interest, this is kind of a metric that can provide some insight into market sentiment. Open interest in crypto futures, right? So kind of a rapid increase in open interest is very can kind of be seen as very greed heavy, but kind of moderate and slow growth of open interest is usually a return to bullish sentiment. According to the exchange data site Viewbase, open interest on Bitcoin has increased 1.7%, while interest in ETH has increased 1.2%. And yeah, after the recent liquidations, this kind of moderate increase, my take is that it shows some level of strength and confidence returning to the market. Same view, different view?
Yeah, well, I think for the last couple of weeks, what has been interesting, so when there is liquidations happening, you sort of wipe out a lot of the leverage, right, that is in the system. And as we know, I look at Bybit funding rates, because to me, that's the retail sentiment. And look, crypto continues to be a very retail heavy market. And so to me, that's when I look at funding rates, especially in Bybit and some of these platforms, it's basically how much you're being paid to go long or short a particular asset. And once you go above a certain level, 0.1, 0.15, 0.25% per day, to me, that sounds like, things are overheated or conversely, like just on both ways, long or short. And so you always look at that as a proxy of how much leverage is in the system. And, the last year, you sort of saw these episodic events where a funding rate sort of almost systematically, if funding rate hits like, a certain level, you would always be like, all right, it's going to be a matter of days until you have these cascading liquidations, right? Because it doesn't take much to wipe out a lot of these positions. Mind you, a lot of these folks are going 10x, 100x leverage on assets that you should, with a lot of volatility, right? What has been interesting as of late is that it has been sort of tamed in terms of this open interest and these funding rates. And so it sort of puts into question, what is the overall sentiment of crypto markets? Because going into the year, there's no surprise, right? A lot of funds are open-ended, so they raise capital and they deploy. Jeff Dorman, I think, is an interesting observation. The first couple of weeks of the month tend to be really strong for crypto across the board, right? Because funds receive capital and they can start deploying and buying into these assets. And so it has been interesting that the markets have sort of stabilized across a certain range. Like I think there was a lot of resistance in ETH hitting 3,000, Bitcoin 40,000, 41,000 sort of defended that well, but open interest hasn't gone up as much, and so it sort of puts into question. I think to me it feels like folks are still jittery, and that's going to probably continue to persist. There's a lot of macro noise, and so I think this is all near term stuff. And I'm not an expert on this stuff, but I think funding rates really do offer a view into how market psychology.
Yeah. Let's get into the meat of things, Santi. I think this episode we need to focus on kind of this rebirth of tokenomics. For context here, the last couple of years, the strategy was basically launch a token, right? Get the token out the door, figure it out later. And I think we are just starting to enter the figure it out later phase, right? Now that a lot of it kind of feels like a lot of the froth has been sucked out over the last maybe month or two. Things are maybe becoming a little bit less speculative, though there's obviously a big counter argument to that. And it's kind of becoming, how can I not just let me get this token out the door, but now it's how can I tweak governance to actually accrue value to the token, improve value of the platform, and most importantly, how to incentivize the users to do both of those things. And that's kind of coming back into vogue after I feel like not being as popular over the last couple of years. So last week we talked a lot about the curve wars. This week we're going to be talking about Yearn. Two main characters that you have to know here. One is Andre. Andre spearheaded Yearn Finance, which has over $1 billion market cap right now. Keeper Network, and he's just been, he's arguably one of the best devs in the space, most influential, most impactful devs in the space. And then Daniel Sesta launched Abracadabra, Spell, Popsicle Finance, Wonderland Finance, which is Time, a whole bunch of other great DeFi projects. So let's start with Yearn, and then we'll get to Andre and Daniel's new project on Phantom. So with Yearn, right, for those who don't know, Yearn is kind of this aggregator or sort of like suite of products in DeFi that provides lending aggregation, yield gen, insurance on ETH. Instead of me explaining the backstory of Yearn and things like that, though, Santi, you were in the design process, right? You were there since the initial mint. Mm-hmm. Can you kind of just give us an overview on Yearn, like the initial model and what you think is important before jumping into these updated tokenomics?
Yeah, so for context, Yearn was really made a big splash because it was the first protocol that issued all of its supply to liquidity farmers. And that sort of was the first iteration of this sort of new concept of you provide liquidity to your protocol, you get a token back, which is a governance token. And as you said, the idea behind what would be governed in these systems was sort of predicated on, hey, you build a big community, you build liquidity, and then that allows you to, he who controls sort of liquidity and community can do interesting things. Over time, it sort of increasingly felt a couple of things. That you didn't have enough tokens to incentivize the team long term to continue to develop, right? A lot of these devs are super talented. Yearn has probably one of the best teams out there. But, other protocols started poaching these devs. And so it put into question, well, what is really the function of Yearn, of Wi-Fi, the token of Yearn, the ecosystem, the protocol? And in that process, in talking to a lot of stakeholders, we decided to make an initial mint of increase the supply of Wi-Fi. By a healthy margin to have ammunition to give these tokens to developers, strategists. Mind you, Yearn is sort of a yield farming kind of a aggregator. So it has these vaults, which makes it super easy for someone to deposit into that vault, and the strategists, which are do a lot of the heavy lifting in capturing yield, right? And so that was the first part, which felt, okay, let's mint, let's give it to the team and have some in reserve to have the ability to, from a business development standpoint and just incentivize liquidity providers. And just, you always need to have some tokens in reserve, as we've talked about in prior episodes, as ammunition to incentivize people, right? Because it's a very competitive landscape out there. It's ruthless, kind of, people, one up each other on incentives. What is interesting now is in that initial mint proposal, my thinking was, well, you never really just want to hoard a token, right? There needs to be some functionality. If you look at the design space today, you have protocols like Maker that MKR serves as the backstop. If there is an insolvency in these protocols, mind you, because there's a default, there's liquidations that there's a shortfall, right? Then that if you're holding this token, then you are acting as the backstop for that, right? And so that sort of makes sense, right? Aave has a similar mechanics, and other protocols kind of have experimented around that. And others, just like Uniswap, is like, look, you could earn some of these fees, but it's not sort of embedded and it's up for governance. And so back to Wi-Fi, I think now is super interesting how they've thought now in that second instantiation, okay, let's make Wi-Fi and the idea of what it serves in this ecosystem actually more productive. And I think, I don't know if you want to go into the specifics, Jason, but I think it's very thoughtful around, the idea of what do you, as staking Wi-Fi, you have the ability to earn more Wi-Fi, but you act as sort of like a backstop. And that makes sense, right? Because at the end of the day, you want to have an insurance fund in case funds are lost. I mean, Yearn has been hacked. I think their DAI vault was hacked. There's a minor shortfall, but still, I think, again, it's this idea of giving more functionality to the token. What has been nice to see is that, just as a last point of context, initially there was a lot of tension amongst the community where there was a camp that said, listen, Wi-Fi had a fixed supply and you shouldn't increase the supply. It's sort of sacrosanct. This is sort of more of a Bitcoin scarcity gives value mindset. And another camp that said, listen, no one cares. Like, you can have a fixed supply, but if at the end of the day what you need to kind of focus on is driving more value for users and having a sustainable protocol, right? It's super early. And so I think ultimately most of the community members decided, look, it's probably better to mint more Wi-Fi and make it somewhat inflationary.
Yeah. So let's get into what they've recently done, right? So late December, changed up the tokenomics. Wi-Fi soared like, I don't know, 50, 100%. I forget the actual number. So there was a proposal a couple months ago that basically said, we want to update the tokenomics. We want the community's input here. What should we do? I think there were like 200 different proposals here. And in late December, they decided to move forward with one specific update. So the big thing here is, I mean, there's a lot of different things we'll talk about, but Yearn has started massively buying back Wi-Fi for people who stake, right? And they're starting to revisit the tokenomics to move to this like fee distribution model to holders. Currently, looking at different models like the VE curve and the X sushi models, and Wi-Fi, for people who don't know, like they're making $100 million a year, $100 million bucks a year in fees from the vaults that are not currently based on incentives or these dilutive tokens, right? They have a treasury right now of, I think, over 100 million plus just earning interest. They have over 5 billion TVL. The market cap's only, I think it's like 700, 800, 900 million right now, yet they have one of the highest fees per TVL. And they're also one of the only kind of truly 100% decentralized DeFi products. And so let's talk about kind of what they're moving to, right? I think what's going to happen is that Yearn ends up shifting to this like VE. And for those who missed the Curve Wars episode last week, VE is a vote escrow model that I think you're going to start seeing pop up all over the place. So they'll end up shifting to this VE Yearn model where DAO treasuries will actually start accumulating Wi-Fi in the same way that DAO treasuries started accumulating like CVX and CRV, so that they actually end up getting a cut of this $100 million revenue and directly and directing some of this like powerful votes on the locked CRV assets. So
I think if we were to kind of zoom out, what is really interesting is two things. One, it sort of gives the token more life and reason to hold the token, right? My biggest issue with Yearn, and mind you, this is not just Yearn, but there are some tokens out there you just feel, well, what's really the purpose of having this? Okay, XSushi came along and said, well, it's interesting, right? These protocols, some of them can accrue a lot of fees. If you're staking, then you can earn some of those fees. But my biggest object is that there tends to be some disconnect in, okay, a lot of these DeFi protocols, fine, you provide liquidity, you issue tokens to liquidity providers in hopes that they might be adding value to this community over time, right? The problem is, the biggest thing that I've always felt is a lot of these guys are just mercenary. They're big operations that come in and farm and dump. Like you give someone the ability to dump, they will. They will capture, they will do some hedging and run delta neutral strategies, which means they will supply something like Bitcoin and ETH that they're long, or they'll just hedge that and be selling this governance token for yield, purely for yield. And I just think that that's a very expensive way to go to market. Now, Staking is interesting because again, it can it you have more skin in the game if you're staking, meaning you can earn some yield, fine, but you're on the hook. If this protocol goes down or there's some insolvency, you're again protecting users, right? If you're protecting users and you're putting users first, then I think like every other bank, right? Then you are in a more competitive position, right? There's still a lot of risk in DeFi, and so if you stake Wi-Fi and you can cover some of the shortfall, if there's a shortfall, then that makes to me more sense, right? And earning fees by doing that also makes sense. So I think like ultimately, Yearn is not will not be the first, but it's certainly going to probably set a standard into what we're already starting to see with Olympus and Fei, like protocol control value, protocol control liquidity, which seems to me more like of sticky liquidity sources, sticky community, which community can be a very fluffy word if you give people tokens that they can sell immediately, like without escrows or without any other incentive or reason to hold it. And so I think in this case, I think what you're going to see is probably a shift and realignment of people that really truly want to be participating in this protocol and staking it and governing. For instance, we in the Curve episode, I think again, this narrative of protocols are going to compete for these governance votes. These governance votes are going to continue to have more and more power. Why? Because you're shifting from individual liquidity providers to how do you incentivize, like protocol to protocol incentives is what we're starting to see here. And I think a lot of these new token redesigns are putting that front and center because ultimately that's really what you should be striving for, right? How do you convince, if you're JPMorgan, how do you convince another institution to use you guys, right? I mean, this sort of classic business development. And this is just a testament of as this industry becomes more and more institutional, protocols really are the institutions here, right? And so you have to make sure that your token design factors and takes that into account.
Yeah. Well, I think it's important to kind of look at like what actually happened here, right? So kind of like the 4 steps and then what actually this incentivizes and how this will fundamentally change a lot of the different protocols moving forward. So, I mean, first, like step 1 is kind of, you got like X Wi-Fi, and tell me if I'm wrong with any of this, right? Like you've got X Wi-Fi, you can stake in the X Wi-Fi vault, and where you're basically earning bought back Wi-Fi from the treasury, kind of simple as that. Step 2 is you've got this like VE Wi-Fi, which is the vote locked Wi-Fi. The more you lock it up, the more you earn kind of these disproportionate rewards compared to those who lock for a shorter duration. You can obviously exit at any time, but you end up paying a penalty. Step 3 is you've got these vault gauges where you stake your Y vault, I think it's called, in a gauge, earn Wi-Fi rewards, and that gets boosted by how much of the VE Wi-Fi you have staked. And with that, you get to vote on which vaults should actually get allocated rewards. And then the 4th thing is useful work, right? With the VE Wi-Fi holders, they are actually earning additional rewards by doing useful work. That could be like configuring vault parameters, setting fees, providing insurance. So zooming out here, like what does that actually do? What does this even mean? To me, what I'm reading is you're incentivizing long-term holders, you're incentivizing people to buy the token who want governance, and you're incentivizing people to buy the token who actually provide value. This is powerful, right? Because now you're moving to a model where instead of people just buying tokens for very short term, all of the incentives are moving towards we want people who are incentivized to be long-term holders who actually provide value to the thing and who maybe want a voting say. And what does that remind me of? It reminds me of moving towards more of a company like a model like companies have, right? Like we wouldn't ever want to give equity in Blockworks to just these like really, really short-term holders. We want to give equity in Blockworks to people who are incentivized for the long term, who actually provide value, right? Who actually want like a seat at the table and want to decide kind of these long-term decisions at Blockworks. And so that's what it reads to me. But I'm curious what you think of that.
No, I think you're absolutely right. My biggest criticism in a lot of these kind of token token designs is that they will probably, most of them, be really expensive customer acquisition strategies. And I always like to go back to like the OG of DeFi and farming is synthetics. And synthetics just got it really right. Where if you remember, like if you were staking your SNX, your rewards were escrowed and locked for a year. And so what did that do? In the initial days, you attracted a very strong, small, passionate community that was, that Discord to this day is bumping. I mean, we call ourselves like the Spartans, right? And so, it to me, that's the healthy and more sustainable way of going to market, right? And then I've been sort of, so synthetics kind of got that right, but you in this weird, very competitive DeFi ecosystem where protocols just feel that they need to they need to have juicier rewards and liquidity mining programs and have the highest yield. And yeah, sure, it's sort of a vanity metric of, oh, look at how much TVL I have, 100 million in 24 hours. Well, who cares, right? Because people are going to move on to the next farm, and the next protocol has the best incentive. And so that to me, just at some point, I think we went through this healthy correction after DeFi summer where protocols were starting to think, okay, well, things are quieter now. How do we actually think of creating more sustainable, which are still not sustainable to be fair, at least more sustainable strategies? And I think the protocols that have done that right, Olympus, I think that did that right. Fei in protocol control value kind of set a new standard, and it's good to see that. I think we're still very early, but I think you see Curve moving this direction too, and Convex. You see Wi-Fi kind of rethinking this, and it's good to see that. And I think, as we've said in prior episodes, the protocols that can adapt and actually importantly, have the ability to change the token structure, because some of these protocols can't. It's sort of like embedded, and you can't really modify this, will have a higher probability of surviving over the next 5 years and really come out as dominant forces in this DeFi ecosystem. Unfortunately, some of them are not going to survive because they blew their load, and they just gave away all the tokens, and
Well, what do you mean by that? Why can't some protocols change the token economics?
Well, I'll give you an example of that. If governance is kind of botched, like Wi-Fi agreeing and convincing the community to vote to mint more tokens was difficult. It was very difficult. Thankfully, the keys had not been burned. And so you had the ability to go back, and the deployer contract of Yearn was able to mint more Wi-Fi. Right? And so if you remember, there was an initial proposal to burn the keys, meaning there would be, actually it passed and it didn't get implemented. We can talk about that later. But there's a lot of focus around, I think the initial supply was 30,000 Wi-Fi. And people kept looking at that number, and they said, burn the keys. No one, the same within Bitcoin camp, no one can increase the supply. And so that had been the case. If you had actually burned the Wi-Fi, like the keys, right, you would have been able to mint more Wi-Fi. And you wouldn't have been able to create all these different incentives that you see now being proposed. And so could you have migrated the token to create another Wi-Fi? Well, it's sort of like not ideal. Okay, it's possible, but still not ideal. And so that's what I mean by some protocols are a little bit more, is it impossible? Probably not. At the end of the day, you could probably migrate and create a new token and migrate the community, but it's certainly more difficult. And so that's what I mean by that.
Yeah. All right, friends, quick break to share some exciting updates from Avalanche, one of the leading L1s. First, the Particle NFT sale, powered by Avalanche. Particle has fractionalized high-end art into 10,000 NFTs, the first piece being Banksy's Love is in the Air. Check it out, particlecollection.com. Number two, an ILO, initial litigation offering, has started on Avalanche in partnership with Rival with a Y, a community fundraising platform for court cases. Really interesting use case there. Number three, enterprise partnerships growing on Avalanche. Deloitte recently partnered with them to optimize logistics around natural disaster relief and claims payouts. MasterCard also tapped them to help accelerate crypto startups. Number four, last but not least, I got an early look at a report from the Crypto Carbon Ratings Institute that shows the energy usage of various L1s. Avalanche came out very low in terms of total energy usage relative to other L1s. Thank you, Avalanche. Big thanks for sponsoring Empire. Now, let's get back to the show. All right, let's get into VE3 of 3. So first off, VE3 of 3, big shout out to this guy on Twitter, Jack Nywald, who's been exploring this a lot. Really helped me out. I'd recommend you guys go follow him. With the curve wars heating up, it only seems fitting that Andre is not only working on Yearn, but also is rolling out a project that incorporates curves and Olympus's really innovative approaches to token design and incentive alignment. Really early days, obviously. Thing hasn't even really gone live yet, but a lot of kind of early speculation looks like VE3 of 3 could kind of change DeFi forever. So you've got Andre, you've got Daniel Sesta. They've banded together to create this kind of new, secretive, highly anticipated project. So here's what we know so far. What does it do? How does it make money? Basically, it's a new exchange. It's kind of like it's an AMM is what it looks to be, like Uniswap and Sushi and Trader Joe and all that kind of stuff. But instead of being controlled by liquidity providers like the LPs, like Uni and Sushi, it is controlled by the protocols, right? So I thought Jack laid out the it's like really easy to understand, like the 4 stages of crypto exchanges. So stage 1, you have centralized exchanges with centralized liquidity, right? Stage 2, you've got decentralized exchanges with LPs. That's kind of what he calls mercenary liquidity. Stage 3, you move into protocol-owned liquidity, where the protocols actually become the LPs. And stage 4 is VE3 of 3, protocol-owned AMM, right? I can talk more about the actual tokenomics, what this thing really does, the staking mechanics, all that kind of stuff. But high level thoughts. What's your take on what Andre's working on? I don't know if you've talked to him yet, but what are your thoughts when you read this?
I have not talked to him yet, but I also find it quite fascinating. I think Andre's. It's good to see Andre kind of be more kind of centric on token design. I think initially at Wi-Fi it was like, look, I just don't care. I just want to give this away for free. But now I think this to me feels like a different Andre that is much more focused on applying all the different learnings, both that he's observed in the protocols that he's been a part of and or involved, and also what else has been happening in the ecosystem. And, you know, I think it is quite interesting, this protocol-owned AMM. And again, it has a lot of the elements that I like, which is attracting long-term, more aligning the interest of liquidity providers into these AMMs. And it's interesting how you're actually going to be able to earn this token, right? A lot of times we're used to anyone can just buy the token or just kind of, as we say, ape into this token, or which was like Keeper was kind of like that. Now this actually to me sounds like it's going to be very strategically handed out to the people that make the most sense here, which is protocols that have been operating and running on Phantom, which is a network that he's been a big part of and supportive of over time.
Yeah, you can't just buy the token, right? You can't just buy the token on the open market. It's going to be distributed to, this is my understanding at least, it's going to be distributed to the top 20 protocols on Phantom by TVL, which makes it interesting, right? Because then the only way to get the upside here, at least right now, if you think this is coming, you think that Andre's really good dev, you're excited about this. There's only 2 ways to really play this. It's like you buy a Phantom, which is essentially buying the whole Phantom ecosystem, and then you also, or you start buying some of your favorite protocols. The top 20 like Phantom protocols.
Yeah, I mean it's interesting. Why? Because like, okay, so back to the L1 kind of discussion that we were having in prior episodes. This might just catalyze an entire kind of Phantom winter, if you will, where, you know, you have a much more
Phantom summer. Wouldn't this make Phantom absolutely explode? Or is that the
we're in winter phase, I guess, in the northern hemisphere. But you know what I mean? Like this might catalyze a lot of interest in Phantom. In a very interesting way, right? Because Avalanche obviously had a huge ecosystem round near just, which we'll talk about later in the episode, just announced out today. Solana obviously raised a big round from institutions, more VCs. This is just a totally different way of saying, listen, we're just going to airdrop this token, which is pretty novel and interesting. And if you're excited about that, then come and build on Phantom and you might get a slice of it. I've seen a few protocols be now much, much more interested in saying, hey guys, maybe we should just deploy quickly on Phantom to get a piece of this and just and ride it out. And so I think it's a genius marketing and business development go-to-market strategy to bring more activity to the Phantom ecosystem and align a lot of these protocols to use the MM.
Yeah, and if you look at this here, I mean, if you look at like the TVL on ETH, right, 24 hours, it's up 1%, Terra's up 5%, Avalanche up 2%, Solana's up 2%, Phantom's up 19%.
There you go.
Right.
There you go. People are playing the airdrop, or protocols, I guess, are playing the airdrop.
Yeah, exactly. I think there's one other interesting thing here, which is the VE. Okay, so let me try to make sure I understand this. Basically, you have VE, which is the vote escrow mechanics, kind of operate like convex and curve, right? Where the vote escrow, you lock for longer periods of time. That gives you higher rewards and a larger share in voting. In the governance of the protocol, you also have to lock and can't sell your tokens, kind of like convex, curve, whatever. The staking dilution mechanics, the 3 of 3, are kind of like Olympus DAOs, right? Where the protocol is worth a minimum of its treasury value. It trades at a premium to the treasury value. Larger the premium, higher the API, tokens rebase over time, etc. Here's the kicker. You can't actually sell. You can't sell most of the VE tokens. They're stuck in the wallet. But with this new protocol, the VE tokens become NFTs. What this means is that you can now sell your basically VE tokens on the open market. So suddenly you've created a secondary market for locked governance tokens, which is now a way to sell voting power. Yeah, I don't know. As opposed to like the non-transferable VE mechanics, tokenizing the lock position allows these locks to be traded on the secondary markets. I don't know. There's going to be some interesting things that come from this. What are your thoughts here?
I actually quite like it. It reminds me a lot of WineSure. You remember like Andre deployed this WineSure model, which was Nexus. It was just a secondary market for Nexus Mutual, which is one of the largest, if not the largest insurance market. But you couldn't just buy cover in Nexus. You had to have KYC. So a lot of people didn't want to do that, couldn't do that. And so you created these like NFTs that represented a particular cover for, a particular protocol. And that was fascinating because it created better price discovery for, this will essentially, like any other secondary market, will create a pretty robust, healthy price discovery for this asset token. And or having a claim on some of these tokens or fees, if you will. So I think it's a very clever way of doing it. We've always talked about NFTs are not just digital art. They are contracts, and they can represent so many things. Again, you can attach and append all kinds of data to these NFTs, and I'm super excited to see how this thing kind of behaves. So I think it is probably the first that I've seen. You can also imagine like this could be applied to so many other different protocols. Like you're staking your ETH, and you want to sell kind of like a stream of staking yield for the next 12 months. You commit to locking your ETH with a validator, and then you sell the NFT as a contract, like as a whatever, representing a claim, a discounted claim on future kind of staking rewards or fees. I think that's pretty awesome. Like these are massive derivative markets are massive in traditional finance, and NFTs are how you do this in DeFi.
If you have these governance votes though, these like VE votes becoming going on the secondary market. I don't know. Mike was we were talking about the launch of like LooksRare, the NFT thing, and Mike and I ended up getting into a long chat about vampire attacks. And this is Mike's thing, not my thing. I got to give him credit. But he said vampire attacks are the new activist investors, right? So in like, and when I think about we got to get Jeff Dorman on here to talk about this. But in old finance, right, like Bill Ackman steps in crypto. There isn't like this massive. I guess you're just starting to see like the rise of these quote unquote almost like activist investors or like activist protocols. Yeah. So.
Yeah. Look, I mean, one of the things that I think I always think about when you actually are factoring in the possibility of governance attacks, and especially if you're borrowing tokens. So a lot of what I think has been fairly nascent, not as explored, but one of those things that are like known unknowns, which is that worry me a little bit, is the possibility of attacking these networks by capturing a lot of governance power and passing a proposal, and then that could be malicious to the network. In this case, simplistically, like if you acquire if you corner the market for these NFTs, could you acquire sufficient governance power, and or are there mechanisms in place to prevent that? Obviously, you could run up the price, and it becomes pretty expensive to do so. But I think. A topic for future discussion, especially when we talk to Jeff and some of the other folks in the ecosystem. But yeah, I think this year and going forward, the possibility, and I think we'll see more and more governance attacks as there's more value in these systems and the possibility to change certain parameters, fees, where you divert the fees. Like, could a protocol come in, corner the market for these NFTs, acquire a lot of staking power, and then pass a proposal and divert fees to their protocol or liquidity to their protocol? Absolutely. It's going to happen. Yeah. So it's going to be interesting to observe.
Yeah, if this works, I mean, it completely changes how protocols operate and changes the model of governance and liquidity wars. So probably nothing.
Yeah.
Cool. Let's. I think this is a good segue. I mean, we talked a lot about Phantom because Andre and Daniel are building this on Phantom. One interesting thing, I know you're very close with Kane, is so I'm not sure how much you can share here. Is Kane? Kane tweeted out last night. I'm starting to come around to the idea of deploying the synthetics exchange contracts to multiple L1s. This is purely based on a concept that emerged recently for synths to act as fast withdrawal bridges across networks. And then he's got a whole thread on it. So this is in contrast with Kane's take like a month ago, where it's very, very ETH heavy, very like ride or die ETH. And now he's saying, might deploy to multiple L1s. Is Kane coming around to the multi-chain world?
Well, I haven't spoken to him since that tweet, but it certainly would appear that it is an interesting shift in his tone and his willingness to explore other L1s. I mean, he's been very focused on optimism as an L2, but this particular L1s. If you look over time, I think he's first and foremost one of the strongest builders in the space. He's been around for a while, and he's gone through and acknowledged the fact that as an ETH, a community, we need to be more practical and focused on this idea that look, other L1s are coming and users are going there, and it's a threat. I don't think of it as a threat. I'm more of the mentality that this is win-win. Like the success of Solana is not mutual, doesn't detract necessarily from Ethereum, if you know what I mean. Now, he was more of the camp that, look, it does. And in the multi-coin episode, there's obviously perhaps more of a view that there may be a winner-take-all at least for winner-take-all for specific use cases, which I sort of have different views there. But I think this is a different Kane. I think it's a more practical Kane. And people need to remember, look, I mean, Kane ultimately, he's sort of a benevolent dictator of the synthetics ecosystem, but at the end of the day, these protocols are governed by a community. And, I don't know what's going on in his brain, but faced with the possibility of saying, do I want another protocol to eat my lunch? Because other DeFi protocols that are based in Ethereum L1 have been much, much more practical and deployed in other L1s. And so, ultimately you look at that and you say, yeah, I mean, I'm at a disadvantage if I'm just going to be ETH-centric. And so I think that's where that's coming from.
Yeah, totally. Jumping over to another L1, Terra, right? Kwon tweets out this thing yesterday morning. LFG.org, redacted, coming soon. A lot of hype in the ecosystem right now over Redacted, as people are referring to it. You hit the website. This is what it looks like. It's literally just Redacted, coming soon. There is speculation here, Santi. There's speculation that Terraform Labs has raised $2 billion from MasterCard in exchange for discounted Luna, locked for 3 to 4 years, with all proceeds going towards buying Bitcoin as a reserve asset for UST. I think that's a little far-fetched. I don't think MasterCard came in and scooped up $2 billion here. There's also just kind of a rumor that Terra raised, maybe it's more like $1 billion. Maybe it's not from MasterCard. Maybe it's just from some big investors. They probably got in at like a 20 or 30 or 40% discount to the Luna price when it was trading at maybe like 50, 60, 70 bucks or 65 bucks. So what's the scoop? Give us the alpha, sir.
I cannot leak alpha here because I'm actually not in the loop, even though I do like Terra. That logo, blurred logo, sure looks a lot like MasterCard. But, that was a playful guy, and so I'm sure I'm not confirmed. But it would make a lot of sense. I mean, if this were true,
Let's see.
Let's just toy with the idea. If it were true, well, why would MasterCard want to do this, right? Well, let's explore this idea. Well, Terra has been pretty interesting from an e-commerce perspective. It has Chai, the wallet, which competes against Kakao Pay and Ali, similar to Alipay, but Kakao Pay and all these different things, right? And so it's been a pretty interesting retail app that has been used for e-commerce as a primary onboarding mechanism for then Anchor and Mirror and a lot of these, broadly the Terra ecosystem, right? But you need to have a killer app. In this case, it's a wallet that you're going to be using for e-commerce that provides incentives for people that instead of paying with your Kakao Pay or whatever card, you use Chai, which is a wallet of Terra, to use. Why? Because it will give you incentives to do so, meaning Luna, right? Or discounts or whatever, in some way, shape, or form. The same way that a credit card, when you swipe, gives you rewards, right? Well, the credit card that gives you the highest rewards, Jason, is probably the one that you're going to use, right? And so in this case, maybe MasterCard is feeling a competitive disadvantage with younger cohorts, younger generations, or geographically, right, in Korea and some of these other markets. And would it make sense for them to partner with someone like Luna? Probably. I mean, why not, right? I mean, MasterCard's competing against, Visa, which is about a punk. I don't know what their strategy is, but again, I think this is the super bullish case for what really leads to. We talk about in an episode with Stani, how can we get to $1 trillion in TVL, a DeFi? I think it takes a big player like this to say, well, I probably want to go first because they're just the users are here. The younger generations are here, and in order to survive and stay relevant and continue to grow, if you look at their core business, like Visa, MasterCard, not particularly high growth companies, right? And so how do you reinvent yourself in the next 20, 30 years? Well, you enter the space. And so if you come to that conclusion, you say, okay, probably makes sense to partner with someone like Luna, who's been around, right? And has a pretty interesting ecosystem, hypothetically speaking.
Yeah. So here's the counter, though. What we saw Michael Saylor do with MicroStrategy is like he's turning MicroStrategy into a hedge fund, right? Where the hedge fund buys Bitcoin.
Yes, although I think you're missing a piece here, which is he reinvented MicroStrategy with Web 2 to Web 2, Web 1 to Web 2, right? And then he also has been very early in identifying trends, and so he pivoted. A lot of the business model of MicroStrategy has evolved over the years, and it's a data business model, and so he went heavily into mobile. And I think what he sees now is like, look, blockchains are data rich. I mean, it's a perfect ecosystem industry to go mine this data and provide valuable insights for people. Now, of course, a lot of the balance sheet right now, MicroStrategy is sort of like proxy for Bitcoin exposure, the same way that like Grayscale products are, with maybe an equity kicker of him reinventing the business. But I think that if I'm thinking of why Saylor's gone so heavily into this space, is to totally reinvent the business into being the first and one of the best data providers in Web3.
Yeah. I guess, I think you're right with Chai. I mean, it's like if you can think of Chai as like closing this like proverbial money loop for Luna in South Korea, MasterCard closes the money loop for the rest of the world. We'll see.
Okay, so like the last thing I'll say is we should link here to two things. One, there is some great ads from Visa when it was getting started. Like, absolutely amazing. And I tweeted about this way back. It's actually quite interesting to go back and remind you 20 years ago, the idea of using a debit card, the idea of using a credit card was like orthodox. It was like people used traveler checks and cash and all this stuff. And it's really interesting to see how far we've come, because now most people don't carry cash. Most people think of using their credit card. And it's, we just got to remind ourselves that like it was not too long ago where people were dismissive of credit cards, and the idea of traveling with plastic that would somehow represent and abstract the cumbersome and actually risky proposition of carrying cash or notes or whatever. I don't think it's far-fetched. It'll be interesting, but I think I will say I think e-commerce payments, if you look at Shopify, Visa, these guys are poking around. I don't think unlike 2017 where it was a lot of announcements like New York Long Island Tea or whatever, like people just announcing they're going to enter block. I think this is substantiated. It's real. They've had 2 cycles now to think about their strategy. And look, maybe in 2017, here's the difference. 2017, you didn't have useful applications. You didn't have users. Now you do. You have credible users, especially if you look at NFTs and gaming. And that always puts pressure on companies that are not growing, right? And invariably, they're going to want to chase different cohorts. The same way as a total tangent, I'm sorry here, is Match.com ended up being the first investor in Tinder. Why? Because think about Match.com. It's usually old people that use Match.com, the traditional website. Tinder was used by young people. So why it made sense for them to go out, invest in Tinder, and own Tinder, because again, it's a customer acquisition strategy. They want to own that relationship over the years. And in a similar way, MasterCard and Visa and Shopify and all these folks are feeling the pressure in their core business, and they need to reinvent themselves. Otherwise, the innovator's dilemma is top of mind here, right?
Near Foundation just closed $150 million funding round. I know that you are friendly with a lot of the folks who are in it. Three Arrows, Mechanism Capital, Dragonfly, Andreessen, Jump, Alameda, Amber Group, and others. Can you tell us kind of the inside scoop, what went on behind the scenes here? Why did this happen? What went?
Yeah, so full disclosure, I participated in that as well. So we're going to bring Ilya into the show to talk more about it. I think it's, look, I mentioned in prior episodes, I think, and in my predictions for 2022, Near has one of the best tech out there in my estimation. It is quite interesting. And I think they just needed a push from a business development standpoint. And so obviously, I think it's sort of mirrored around what other L1s have done, starting with Solana, then Avalanche. And I think Near just sort of is deploying just sort of the same playbook to attract projects and just raise the profile of the project. I think it's some great builders, but more so in the background. Now I think it's more of a concerted effort to elevate the profile of the protocol and attract other teams to go out and build on the Near ecosystem. So I think that's sort of the intuition behind this round.
Let's get into some of the top news. Yeah,
let's do it. Yep.
Cool. First things first, Coinbase. Big acquisition. Actually, this is kind of an under the radar acquisition. They basically acquired a CFTC regulated derivatives exchange called FairX. FairX, not that popular, I'll say. This is, in my mind, a regulatory arbitrage play. The market for crypto derivatives should be absolutely massive, right? When you look at like derivatives versus spot and traditional equities, the derivatives are exponentially larger than spot. In crypto, that hasn't really happened yet. And it's really just because of one reason. It's because of the regulation is pretty tight on crypto derivatives. So again, I think this is Coinbase saying the market should be huge. Let's push heavy into this space while we can before this entire space unlocks because of regulation. Good take, bad take. What do you think?
I think that's spot on. And I believe that they've done this. There was another company, LedgerX, I believe that FTX acquired.
Right.
Was it LedgerX or was it's a Chicago-based
shop?
Yeah,
LedgerX. Yeah, exactly.
It had a lot of licenses because I remember looking at the seed round. It had a lot of licenses back in the day, and licenses are pretty hard to come by. And so I think this jumpstarts and is, as you point out. I mean, we've talked about how derivatives should be massive on DeFi. They're not today, but this I think is foreshadowing of that, and at least the potential that they see.
Yeah, so I went to try to sell covered calls the other day, and
not because you were a degenerate or anything, but sure.
No, not at all. But I went to, but also I just wanted to explore, and my dad was asking me how to do it and things like that, and I was like, all right, let me figure it out. And so I was actually astonished by the lack of places to go do that. Right, you can use CME Group, but you need to obviously move in size to do that. And then it's really just kind of like LedgerX, which is now owned by FTX, and then Deribit, which I'm not even sure you can use Deribit in the States.
As a U.S. citizen,
I don't think you can use.
No.
Yeah, and it's not like anyone uses VPNs. So.
Yeah, no. Well, Deribit is widely used, but you need to have you need to be offshore, like just not a non-U.S. person.
So, anyways, I think derivatives market gets absolutely massive. Coinbase pushing in.
Yeah, absolutely.
Next thing is NFTs. LooksRare launched. Basically, this is a kind of an OpenSea competitor. I think there was massive interest in this yesterday because they're kind of doing like an airdrop to OpenSea. They airdropped this token called the Looks token to anyone. I think it was if you had traded over 3 ETH on OpenSea. Yeah, you got airdropped. There's a Dune Analytics chart that I really like. If you look at the LooksRare versus OpenSea volume, the LooksRare volume was massive yesterday, over $400 million, and the hourly volume is just 1 hour is over $100 million in an hour. That being said, if you look at some of the user data, the OpenSea, OpenSea has yesterday had 61,000 users. LooksRare had 3,000. The obvious thought here is that wash trading is maybe a play, right? It kind of looked like LooksRare was destroying OpenSea in terms of hourly volume, but the number of hourly transactions for LooksRare was far below OpenSea. And so unless I'm interpreting this incorrectly, it kind of smells a little bit like wash trading, but I don't know. And then the other argument is, it was it was wash trading, but like, who cares? Why does that even matter? This is just this is a launch, and right, if you have to trade back and forth a few times to get the token, users come to farm, stay because the platform's great. Got to try it to buy it. Brilliant launch strategy, right?
Yeah, not the first time a protocol has done fake it till you make it. That's a lot of even the bigger protocols in DeFi, more established ones, started that way. It feels more credible, to be fair, than SOS. And so I don't know who's behind this. I need to look more into it. But this is certainly a dashboard we should continue to monitor. Like, these exact same stats that we just looked at. How are they going to look like next week and the following week?
Yeah. The last thing I think on the NFT side of things is just a big shout out to Royal. Blau and Justin over at Royal did their first music NFT drop with Nas. If any fans of Nas out there, he just dropped his first music NFTs. Royal, big shout out to them. The next thing here is there are a couple fundraisers. First is ZeroHash, raised $105 million to bring crypto products to financial companies. Shout out to Ed Woodford, really good guy. Their thesis is that every company eventually becomes a crypto company in some form. They want to empower that. 2 years ago, $105 million raise would have, a lot of eyes on $105 million bucks. Today, it's kind of like under the radar. Again, same with Swiss digital asset bank Seba. They raised $119 million 2 years ago. It's a massive amount. Now it's kind of like another 119. The big news, the big fundraiser of the week, obviously Sequoia and Paradigm investing $1.15 billion in Citadel. This is the first time Citadel Securities has taken outside capital. There are a lot of ways to interpret the Citadel deal. I want to get your take first, and then I can share what I'm thinking.
Yeah, well, a couple of things. Citadel is the one that powers platforms like Robinhood on the back end, which obviously have done pretty interesting foray into crypto, and I think they realize the potential of crypto. And so, to me, I interpret this as Citadel trying to get smarter on crypto and trying to bring in valuable partners that can help them, kind of build an entire business unit in crypto. And so that's how I read into the deal. I think Citadel, look, at the end of the day, I mean, you got to understand, someone like Sam, for instance, was at Jane Street. And crypto is a very volatile market. That is sort of a trader's wet dream, pardon my French. And I think, this is just, there's huge opportunity. I mean, probably Kyle and Tushar mentioned this in sort of their thesis on MEV. These markets and the inefficiencies that continue to exist in crypto, and as a volatile asset class and relatively underdeveloped with financial infrastructure, is massive. I mean, it's sort of, you're left wondering, what took these guys so long? Okay, maybe there's some regulatory uncertainty, and maybe the industry sort of matured a bit, and there's ETFs, and there's more clarity, and okay, I understand that. But I think we're at that point, at that inflection point, where people realize, wow, I can build, this is not a trivial market. Like, DeFi has grown substantially over the last 2 years. And I think anyone and major financial institutions are paying attention. But you cannot not have a strategy at this point on crypto.
Yeah. Craziest stat on Citadel is that Ken Griffin owns 85% of Citadel still.
Yeah, I think it was Ken that sold his personal stake.
Yeah,
I believe.
Yeah.
Also, Ken Griffin, who bought Constitution and outbid Constitution DAO. Correct. One of the largest art collectors in the world. Yeah.
Here are a couple other takes that are the contrarian takes. One, Ken Griffin said he's still saying fuck crypto. He goes, I'm going to take these crypto kids' money and not put it into crypto, and that'll show them. So that's one take. I don't think that's the right take, though. The other take is that this is Paradigm hedging out of crypto, Paradigm getting perhaps pessimistic on the market over the next 18 months, wants a little bit of allocation to arguably the best market-making firm ever in the history of the world. They get into Citadel. Another take is that, it's really, really impressive that Paradigm got in this deal. They obviously got in the deal because, I know a lot of people are saying because Citadel wants to get into crypto. It's important to remember the founder of Paradigm, Matt, came from, I think he was at Sequoia beforehand.
He was at Sequoia. I think Sequoia is the largest investor in Robinhood. I believe.
So Sequoia and Citadel are very, very close. Sequoia got in the deal. Paradigm and Sequoia are very close. This is either Sequoia expanding into crypto, is what a lot of obviously crypto folks on Twitter are saying. This could just be Citadel expanding into VC, right? What a lot of the hedge funds over the last like 2 years have done is now they're pushing into VC. Even like a lot of the market makers like Jump and other folks like that have pushed very heavily into crypto VC. This could just be Citadel's expansion into VC, and they see Paradigm as the best crypto VC and Sequoia is the best traditional VC.
I mean, the common denominator here is, and I think we can all agree and see eye to eye to this, is it's quite positive for crypto.
Yeah. Two stories that I thought were just pretty funny. One was on Blockworks and one was on Decrypt. Another great media site. Shout out Decrypt. The first is JPMorgan said that 2022 could be the year of the blockchain bridge. It's just wild. Like JPMorgan out here predicting bridges. And the other is that Bank of America said that Solana could beat out Ethereum to become the Visa of crypto. You've got JPMorgan out here talking about bridges, and you've got Bank of America out here talking about Solana. So I don't know, man. Things are moving so quickly. I find it hilarious.
Yeah. Well, the other one, not to mention, is Goldman, I think, came out with a Web3 report.
Yeah, they did last week.
So, it's that time of year where analysts want to be relevant and make bold predictions. I don't know if these are accurate or not, but it is interesting to at least read about them, even, whether you find them comical or not, or just grossly like traditional media, not Blockworks, always characterizes this industry. Their takes are just like 5 years old, and like they continue to use like stock images of like projects that are not even existed, like Made Safe and stuff like this. But nonetheless, I think there's more coverage. So I mean, I continue to believe any news for crypto is still positive. But yeah.
You know who had a good take actually? Tom Emmer. Shout out Tom Emmer, congressman for Minnesota's 6th district, introduced a bill prohibiting the Fed from issuing CBDC directly to individuals. Really, really interesting, right? He's getting on board. Mm-hmm. What he's basically saying here is if the Fed issues a CBDC, has direct access into consumers' bank accounts, how do you stop us from becoming China? We will inevitably become China, and it is more important, as he said, than ever to ensure that the U.S.'s digital currency policy protects financial privacy, maintains the dollar's dominance, and cultivates innovation. A, I love that Tom Emmer's taken to Twitter to share this thing publicly, and B, this guy gets it. He obviously gets it.
Absolutely. Yeah. No, I mean, I've been very impressed in that as I was watching the Powell's congressional nomination hearing, there were some pretty interesting takes on stablecoins and some smart takes, and it's interesting. Look, I think it was someone who tweeted about this. I think it was the founder Masari mentioned that as more of these politicians run for office, part of the conversation, increasingly so, will be what is your crypto policy and stance on crypto. I think that's probably going to be a theme more and more so now, and it's good to see. I think that the level of discourse has gone up, and the quality of it has also gone up, and that is both very encouraging.
Yeah. All right. Here's the final stat that we're leaving it on. Blockworks tweeted out yesterday, really interesting stat. The world's most visited finance websites in December. Number 1 was PayPal. Number 2, CoinMarketCap. Number 3, TradingView, then Chase, then Investing.com, then Binance.com, beating out Wells Fargo and Bank of America. Right behind Wells Fargo and Bank of America, we have CoinGecko at number 9. Jumping down to 15 is Coinbase. Jumping down to 17 is OpenSea. 5 of the top 20 largest finance websites in the entire world: CoinMarketCap, Binance, CoinGecko, Coinbase, and OpenSea. Love to see it.
I love to see it. And I will predict that CoinGecko probably flips CoinMarketCap. They just did a huge reskin, so shout out to those guys out there. I think they do an incredible work. Bobby and team have just done incredible. They've never taken any outside money. Unbelievable.
I think Bobby was the second ever guest of the show. The second guest ever of Empire. We got to bring him back on.
Oh, we got to bring him back on. We got to bring him back, and we got to get our hands into some of the CoinGecko equity.
I'll go pump CoinGecko all day long. If you think that they have not got at least $1 billion offer to buy that business, you're crazy.
By far. I mean, how much did Binance buy CoinMarketCap? 400
million.
Yeah, exactly. Yeah, that was at the peak of 2017. We're way far along now.
No, that was 2019. No?
No, that's right. That was
Right?
after the peak. Yeah, that's
Yeah,
right. That's
that
right.
was down
So
down market. They got four. Oh no, this was March. Oh no, this is the month. This is when COVID hit. It was March of 2020. They bought them for 400 million.
you may be right. Yeah, yeah.
Yeah, I think it was March 2020, which is nuts. They paid 400 million for CoinMarketCap when the market had absolutely shit the bed. Just think about what CoinGecko's getting these days. A couple billion at least.
Shout out to Bobby.
Shout out Bobby.
Love the site. All right, my friend. Anything else to talk about?
I think that's it. If you like the show, share it with a friend. Go post on Twitter, tag Santiago and me. I promise you I will retweet it if you tag me. So thanks for listening, guys, and we will see you next week.
All right, my friend. It was great chatting with you. And as always, we live to see another week in crypto. Always eventful, and we'll be here next week as well.
See you next week.
All right, my friend. Take care. Thank you, everyone.